welcome back, everybody. Another episode of Who Charted, the most electrifying 6 minutes in markets. As always, Who Charted brought to you by the team at Research by Potomac. With me here today is Drew Wells. You know the drill. 6 charts, 6 minutes. Let's get after it.
All right, big move in the S&P 500 last week. We have the percentage of stocks above the 10 and 20-day moving averages. So breadth is really important whenever we see a big move in the S&P. We want to make sure that that's confirmed by an increasing number of stocks and not just driven by the handful of the index heavyweights in there. So both printing 10-day and 20-day moving average levels above the 80% level. So really strong breadth coming off of the lows right there in March. The S&P is above its 20-day moving average and 10-day moving average, obviously. But take a look at how those lows have been kind of rising throughout February and into March, getting an idea that some stocks could be losing their downside momentum. If the index is going to build a leg to reverse course and drive higher, it's the goodest place as any.
All right, speaking of breadth, keeping it in that family, but shifting gears to the NASDAQ. This is the NASDAQ 100. 4 days in a row last week, saw the NASDAQ 100 have advancers as a percentage of advancers plus decliners click in at over 80%. Not something that we see often. You'd have to go back towards the kind of move out of the pandemic lows to see a cluster of readings above 80%, such as what we saw last week. At the same time, NASDAQ 100 breaking the downtrend line that's been in place for the majority of this year. That's the smaller chart in the center of the pane. If you just look at the 4-day rate of change for the NASDAQ 100 index, last week, it was the best 4-day rate of change once again since the pandemic, clocking in at over 9%. So talking about breadth, talking about potential catalysts to reverse some of the bearishness that we've been seeing in the market, these are kind of the signposts that we look to.
All right, I know everybody is tired of seeing the regular, growth to value chart. We all know what it looks like by now. Here's international growth to value. Spice it up a little bit, right? So testing resistance level at that highlighted zone, long-term area here, but take a look at momentum in 14-day RSI, breaking out of that relative resistance zone after making a higher low right there in March. So, if international growth is going to really start to get moving, it's probably going to happen somewhere around here. Now, obviously, a lot more work needs to be done on this chart. We need to see some follow through. Obviously, we need to see a breakout. If we see that, sort of same development happen here domestically, that could give an increasing bias towards growth, but we still have some significant work to do before we get too excited about it.
I think that's fair. Speaking of still some work to do, but something that's interesting, high yield versus treasuries. This is using the ETFs to get a gauge or as proxies for those two asset classes. What we can see is a consolidation after a downtrend now starting to resolve to the upside. So if we think about what this means for the market, to me, this is a sign of a little bit more of a willingness on the part of investors to take on risk, something that's been absent over the past few months. We've been highlighting that in our work each and every week, but we want to sit up and take notice when high yield treasuries break out of a consolidation, high yield bonds rather break out of a consolidation relative to treasuries, especially as it plays out, on the heels of a strong rally last week for the equity markets led by the NASDAQ with that increasing breadth. So we're going to keep watching that one.
All right, metals and mining. This is one of the most popular inflation-related equity themes, right? So gone nowhere for almost a year there. Broke out in the early part of this year, retested that $48 breakout level above a rising 50-day moving average, and just totally ripped to the upside. If most of February and into March. So take a look at the performance relative to the S&P 500. Again, you see a very similar behavior. Big base, right? Testing a resistance zone, breakout, retest, and go, right? So it's probably a little bit extended here, as far as the distance from the 50-day moving average. So it makes sense to see some choppy action, which is actually what we've been seeing in the space over the past couple of weeks. But it's going to be interesting to see which direction that consolidation resolves in the future.
All right, so metals and mining, breakout, retest, and go. For gold itself, right, which is obviously a key element for metals and mining stocks, we have the breakout, we have the retest. What we are potentially looking for now is the go. Here is the chart of gold spot breaking above, call it 1900, the key level for the breakout, and then pulling back to retest that level. You see a nice rounding pattern. What's interesting to me here, though, is the RSI. The RSI on the pullback has not even come close thus far to threatening 40, the lower bound of a bullish regime for this momentum indicator. And notice the change of characteristic of late. Notice how 40 has been acting as support for the past couple of months on the RSI. So we have a potential momentum shift on a breakout and now a retest. I think that as long as gold spot is above 1900, it has to be on the radar screen.
All right, everybody. Thank you so much for spending some time with us. If you like this video, please don't forget to share and subscribe. We'll see you in the next video.
All right, everyone. Thanks. We'll see you soon.